In 2018, Warren Buffett went on stage and admitted Berkshire Hathaway's biggest near miss wasn't a stock they bought. It was the stock they almost didn't. Two of his quiet lieutenants, Ted Weschler and Todd Combs, bought Visa and Mastercard for Berkshire and turned them into one of the largest hidden winners in the entire portfolio. They did it by understanding something about Visa that Wall Street still misprices today. Visa is not a card company. It's not a tech company. It's the most profitable toll booth in human history. And the reason it can't be killed is structural, not strategic. Let me show you why. Most retail investors look at Visa and see a payment processor. They see crypto headlines and they panic. They see a stock that always seems too expensive, 30 times earnings year after year, and they walk away. They miss the point. Visa, together with Mastercard, forms the most durable duopoly in fintech, and the reason for that comes down to 4 structural facts, plus a 5th one, the Buffett tell, that quietly confirms the thesis. Visa does not lend you money. It does not extend credit. It does not bear default risk. When you swipe your card, your bank lends you the money, not Visa. Visa just routes the data and verifies the transaction in milliseconds. So, what does Visa actually sell? It sells trust. It sells the rulebook, chargebacks, fraud reversal, dispute resolution, regulatory compliance. That is the actual product. Sending money is the easy part. Every fintech app does that. Cleaning up after a fraudulent or disputed transaction is what every business on earth is willing to pay for. Crypto cannot do this. Once a Bitcoin transaction signs, it's final. No consumer protection, no recourse, no reversibility. That's the part nobody talks about. Joseph Carlson, one of the largest value investing channels on YouTube, calls Visa, quote, a toll booth on a bridge that every car has to drive across. Every regulated transaction passes through. That's the moat, not the rails. The rule book, the numbers. For every dollar Visa earns in revenue, almost the entire dollar drops to gross profit. Each new transaction costs them almost nothing. That's near zero marginal cost. Mastercard runs the same model. These margins aren't accidents. They're structural. 3 reasons. 1. Zero credit risk. When you default, your bank eats the loss, not Visa. 2. Asset light by design. Visa doesn't run bank branches, doesn't hold cash, doesn't employ loan officers. The rails were built once, decades ago. Now billions of transactions ride those same rails every single day. Adding one more costs Visa almost nothing. 3. Inflation is literally a tailwind. Their fees are percentage-based. When the price of goods goes up, Visa's cut goes up automatically, without deploying a single extra dollar of capital. Inflation, which destroys most businesses, is a built-in revenue engine for Visa and Mastercard. This is why the margin has not compressed despite scaling for decades. The math is the moat, the regulation question. Every 5 years, Washington tries to break the Visa-Mastercard duopoly. The Durbin Amendment in 2010, the Credit Card Competition Act, proposed regulatory pressure including interest rate caps and mandatory routing rules. Every time, the news cycle scares investors. Every time the stock dips. And every single time, the duopoly comes out intact. Why? Because the alternative networks already exist, and they don't work. The Federal Reserve's FedNow. Push-to-card systems. Each is technically capable. None is operationally trusted. Merchants will not switch. The moat is not speed. It is not cost. It is the rule book, the chargeback infrastructure, the fraud system, the international acceptance, the cross-border settlement, none of which the alternatives have. When rate caps target the issuing banks, they hurt the banks, not Visa. When routing mandates push merchants toward alternatives, those merchants risk losing acceptance with the over 80% of US card transactions that flow through Visa and Mastercard rails. The regulatory threat is loud on the headlines, structurally weak in the actual mechanics, and every dip is a gift to long-term holders. Crypto. The story everyone tells is that Bitcoin or stablecoins will eventually route around Visa. That is not what is actually happening. Visa has been settling transactions in USDC stablecoin since 2021. Billions of dollars have already moved through it. They didn't fight crypto. They turned it into a new settlement layer. And every major crypto card on the planet, Coinbase, Crypto.com, Binance, runs on Visa or Mastercard rails. The bigger crypto gets, the more fiat to crypto conversion happens. Every conversion is a fee event for these two companies. Joseph Carlson said it directly in his recent video, quote, "Any dip you get from stablecoin news is going to be a gift to Mastercard or Visa investors. Heads Visa wins. Tails Visa wins. As long as the rule book remains the trust standard." So, what's the actual bear case? 3 things, in order of likelihood. 1. Valuation compression. Visa trades at 28 to 32 times earnings. A macro shift or rate regime change can push that multiple down 20 to 30% in the short run. 2. Wallet disintermediation. Apple Pay and Google Pay run on Visa rails today, but if they pivot to account-to-account or BNPL routing, they could chip at the volume. 3. And this is the tail risk, a US government CBDC with direct merchant integration in the next decade. Real, but the furthest away. Here's the pattern. Every year, Visa trades at roughly 28 to 32 times earnings. Every year. That multiple looks expensive on paper. Every year, the company grows earnings 10 to 15%. Every year, the stock quietly outperforms the broader index. That is what a real moat looks like. Not flashy, not viral, just structurally durable. Even Berkshire Hathaway underestimated it. Buffett's own lieutenants, Ted Weschler and Todd Combs, were the ones who built the position. Buffett himself called it a near miss. If the most respected capital allocator on earth misread the durability of this network, the average analyst on Wall Street is going to keep doing the same thing. That's not a thesis, that's a pattern. And patterns this consistent are not coincidences. So here's the thesis in one line. Visa is a toll booth on the regulated economy. The toll keeps growing. The bridge is hard to replace. Regulators have tried for 30 years and have not broken it. Crypto became a new settlement layer rather than a substitute. If you're buying Visa today, you are not buying a card stock. You're buying a durable settlement franchise that has compounded at 10 to 15% a year, while the rest of the market keeps looking for the next disruption. The next disruption already happened. They absorbed it. Now, I want to hear from you in the comments. What's the strongest bear case I missed? Valuation compression? Wallet disintermediation? Something else? Drop your sharpest pushback below. I'll read everyone and pin the best take. Not financial advice, but if you found this useful, the subscribe button is right there.